Past performance is no guarantee of future results is on every statement. It's everything. Because they know stone solid that asset manager, it doesn't matter if it's Ray Dalio or it's somebody at American Funds, there is no academic proof that these people can consistently or predictably buy stocks that will outperform the market. And a little bit of bad news, neither can you. Hello and welcome to Your Business, Your Wealth. My name is Paul Adams, and the man that needs no introduction, the man
but you somehow do it anyway. Yeah.
Wishes that his eyes were as blue as his shirts, Cory Shepard.
And this shirt's getting less blue every day, as has been frequently commented. Folks fall out of their chair when they see me in a non-blue shirt, and it started recently because Amazon stopped making my size for some reason. I don't understand.
I'm going to tell you right now, Cory showed up to a team meeting the other day with a white shirt on. We thought he had a funeral to go to.
I thought I was meeting with a whole pack of vampires with sunlight coming in the window. They're like, ah!
Well, so today we've got something that's going to be similar to something we've done in the past. We've done this countless times. If we talk about every time we've had this conversation with a client, every time we've done it at a public speaking engagement.
We've talked about this a lot.
A lot. But what we're doing today is trying to make it more concise. This is going to be the illusions of investing. And these are the things that investors are missing, that they don't realize is out there. The fees that they're being charged by big box financial retail, the lack of disclosure that is totally allowable and totally legal by big box financial retail. And we're going to take that currently is in episodes 163 through 167, but those episodes range from like 25 minutes to 45 minutes. So we assign
like 2.5 hours total.
Yeah. And we assign that to our clients. They diligently get through it, but we're going to record something today that's meant to make it easier for our clients and easier for all of you to be able to take some chunks of this. And either you may want to reach out to us afterward. So, Cory, do you want to tell them how to do that? Because I don't think we're getting a commercial break in the middle of this with the pace we're going to go.
So you can email us at info@sfgwa.com, or there'll be a link in the show notes to schedule a 15-minute conversation with someone on our team just to get the conversation started.
So there's our Sound Financial Group advertisement.
Right.
But here's what I want all of you to think about is, one, there are people in your life who haven't seen this. People who have small amounts of money, people that have large amounts of money. Share this video. Like this channel. Follow our profile. Follow us on social media. You can find us just about anywhere. Just search for Ask Paul Adams, Instagram, Twitter, Facebook, etc. Facebook and LinkedIn are where we post mainly now, but we receive messages on all of those channels. So with that, Cory, are you ready for us to get through this at breakneck speed?
Yep. Roll up your sleeves, everyone. Put on your face shield, not because of COVID, because of the wind streaming by.
And maybe a lot like my wedding night, I'm just going to break it to you guys. This isn't going to be great.
I'm worried.
But it ain't going to last long. All right, let's get into our topic at hand. let Cory recover from that.
Recover, yeah.
All right. So we're going to talk about the illusions of investing. We're not even going to summarize them in advance. We're going to hit them in rapid order. But let's start with why we do this and why most of the financial industry doesn't get exposed to it. Now, Cory has his own stories of this. You guys can hear mine in more detail. But basically, when you start in this business, you start out and there's some friendly mutual fund wholesaler who leads a class of your peer advisors. And it seems like that's normal. Or in my case, they bring sandwiches. Or in my case, they take you to lunch at Denny's. And I was a 20-year-old that, I don't know if I told you this, Cory, I weighed 248 pounds and I was not 1 foot taller. I could put away groceries. So what we ended up doing is going to lunch, and I go to pay because this guy had spent the lunch educating me on mutual funds. He said, no, this is what I do. Which turned into lunches at Ruth Chris, turned into dinners at Ruth Chris, turns into people like Cory and I getting invited on due diligence trips. For those of you listening to the podcast, those are my air quotes tone. And the due diligence trip is meant to be able to go out and learn more about the fund and meet the managers, all that. But it also happens to usually be pre-COVID in a luxe location with great activities, all that. All that's come down to the mutual fund industry is an enormous marketing apparatus. The marketing departments at big box financial retail are no joke, and they go out of their way to get as early as possible in a financial advisor's career to provide the education that they're going to ultimately pass on to their clients. And much of what we're going to talk about today, you'll never get exposed to if you or your advisor are not deeply steeped in the academics of investing. Sorry, Cory, go ahead.
Well, I won't name any names, but I can still rattle off some of the ticker symbols of some of the first mutual funds I was introduced to as a young advisor as my go-to bag of tricks.
Oh man. Or you remember taking a program like Principia Pro and your sales manager would teach you, just put together the portfolio you want the client to have. Principia will find you all the funds in the last 10 years that had good performance, which we're going to see later in this talk may not be the ones that have good performance in the future. Let's hit illusion number one. Illusion number one is stock picking. And the definition of stock picking is someone choosing stocks based upon a belief that they're going to do well in the future. But the illusion is that investment advisors can consistently and predictably add value through individual stock selection. Now, what we don't think about much is World War II and how it counts toward investing. Okay, I don't think that comes up super often. For those of you that are fans of World War II, you'll know we won in large part due to our air superiority over Europe and the Pacific. And people oftentimes, if we ask in a group setting, where did the tide turn in World War II? People say things like in the Pacific Theater, Battle of the Bulge, V-Day, and those are all relevant responses. But the funny thing is, if you ask an economist where World War II is won, he's going to point to a smoke-filled apartment in Harlem. You see, there used to be these folks in the field, these generals and other people that would gather data, and then they would send it back to the United States to be analyzed to give them the math needed to make the decisions that they make in the field. And so a group of these studies came in to this group of government-paid mathematicians, and what they were supposed to do is figure out how much armor needed to be added to these aircraft because they had these scattergraphs of the bombers who had returned and had been shot up. And so they did all the math, and what it was going to cost was range, which was one of our big superiorities, how far our planes could fly, and munitions, what total amount of bombing capacity they could carry to their targets. All the math was done was getting to go out the door, and a guy named Abraham Wald stopped it and said, "We can't send this out." And they said, "Why not? Is something wrong with our calculations?" He said, "No. You're studying the wrong aircraft." You see, if
my stomach just like drops, like we almost is so close.
Well, and you remember the first time I shared this with you?
Mm-hmm.
Cory was working for a big box financial retailer. He later tells the story, and you guys have heard in other podcasts, that this totally changed his view when he saw, like, wait a second, the cockpit, the engines, and the weakest part of the tail are the only place with no shots. You see, those
so obviously that plane was fine.
Yeah, it delivered its bombs and was able to return. In this case, the only parts that had to be armored were basically the engines and the cockpit. We just need to reinforce the tail a little bit, but the rest of it was light armaments and didn't jeopardize our bombing capacity. Now, this is usually where people would ask, what the heck does this have to do with finance? Well, let's go into the individual mutual fund universe. Now, this is from the first mutual fund all the way through to 2017. And that first mutual fund was created by the First Bank of Boston, now called MFS, or Massachusetts Financial Services. Now, we're going to hit this really briefly to take care of the speed with which we need to get through it. But what you can do is go back to episode 163 if you want to see this more in detail.
Well, can I just ask a question for everyone to consider? Why do financial institutions keep making new mutual funds? And would it be because they already thought that they had everything figured out?
It's a great point, Cory. Because if they had it all figured out, wouldn't they just have one really great big mutual fund that always works.com or something that they would name it? Hashtag always pays. But in this case, what you can see is that they consistently and predictably close mutual funds. Now, why would they do that? If you think you had two mutual funds side by side, one of them went up 10% a year for 3 years. Now, same investment objectives, let's just call it a mid-cap fund. The other mid-cap fund went down 10% a year 3 years in a row. Bad stock selection. Now, they got to close one of the two funds. Cory, do you think they closed the one that goes up every year for 3 years?
Why do they close mutual funds? Is it because they were doing really, really good?
Nope. No. It's always because it's the poor performing fund. And you ask yourself. Yeah, go ahead, Cory.
Yeah, the crazy part, you would think that the money from the bad fund going into the money of the fund that's doing better, that rate of return should come along with, and that history should be involved, but it's just left by the wayside.
Like your kid who drops classes in college and they don't figure into his average. It still costs you, but you no longer see the negative performance. That's exactly what happens in mutual funds. How bad is it? Well, this is as of the end of 2017. At the end of 2017, we had almost as many funds killed off as we had still alive. Just think about that. Today, there's more who have been killed off than those that are currently alive. Why? Why? Because it becomes a strategy in which they can close the mutual funds that don't. By the way, you guys have probably had this happen in our audience. What you get is a letter that says something effective. We are going to be combining these two mid-cap funds because similar management styles and similar investment objectives and save our clients money, all that. And then they combine them. But what they're actually doing is erasing the rate of return of the poor performing fund that's having clients leave in droves anyway. They don't want to send you the money back. They want to roll it into something else they control. Well, how bad could it be, Cory? I mean, all these funds that had to close. Well, the worst 200 of them, average was negative 81% cumulative return before being closed. That means half were worse. Like, I don't know how you get worse than 81%, but
if you got that letter in the mail, what happened is your money went down by some degree. It went over into the new thing, but to you, it just looks like it's been growing.
Yeah, that's at least in the historical returns. Part. Yeah. Right. And now, if we look, and all this data is coming from the Center for Research and Securities Pricing and Analysis out of the University of Chicago. And what they did is they did a correction to the survivorship bias. The survivorship bias is when we look at those who made it through a situation and make our decisions based upon that and not include the information and the data from those who did not survive. So this is a survivorship bias corrected cumulative rate of return. You could see those top two numbers near 9 million. Those numbers are just if you had your money in indexes. One is the CRISP index, and then for comparison, we include the S&P 500. That bottom line is your average output, a little over 4 million, if you were in the survivorship bias corrected performance of retail mutual funds and asset managers. So that means the total amount of wealth lost, 4.8 million if you just started with 100 grand back in 1972. Now that 4.8 million is more money than most families are going to have in total in their old age. And that's just the lost wealth to the stock picking inside the funds. Now, we're going to cross into illusion 2, and illusion 2 really answers what's probably going through your mind right now. Well, Paul, you're talking about the average. I'm not the average person, and I certainly would not choose. Yeah, that's right. And I certainly wouldn't choose an average asset manager. And I would say, how would you find who would be above average? And they would say, I just look at their performance history, also known as track record. So this track record, the actual definition of it is the use of performance history to determine the best investment for the future. But the illusion is that finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. Now, it sounds pretty articulate. Seems like it would work, The only problem is that it doesn't. So what this graph could look a little bit confusing.
But it's one of my favorite pictures.
It is mine too. Yeah. So what they did is they studied, starting in 2004, rolling 5-year periods. So 2004 through the end of 2008, 5 years. The end of 2005 through the end of 2009, 5 years. And took only the top 25% of best performing U.S. equity-based mutual funds. And then they assessed them over the next 5 years to see what percentage would have outperformed. And what you can see is the average amount of of asset managers who outperformed is 21%. Well, the top 25.
The top 25 of everybody followed for the next 5 years. Yeah.
Over and over and over again. And what we find time and time again is a total inability for them to consistently or predictably outperform what the market would have done if it was just left alone. So not only do they have survivorship bias in their favor, that they can close a fund that's had bad performance, put it in a new fund, and they disappear that track record. But on top of it, even the ones that perform well are not likely to continue to be able to repeat that performance. And without belaboring it, it's no better really, even with fixed income management for those that are bonds. Now, we illustrate this in our in-person settings by having people flip coins. And after about the 5th coin flip, where if you're heads, you stay standing, you're an asset manager that continues to beat the market. If you got tails, you have to sit down and hand your quarter or your $50 over to somebody that's still managing money. And this is exactly what big box financial retail is allowed to do. They're able to, say, seed 10 mutual funds with $10 million each, and then watch each of the asset managers. If they outperform, they keep their job. If they underperform, their fund gets folded into somebody who performed well. Because haven't you ever wondered why you never see a mutual fund that's being marketed to you with no performance history? There's always like a 3-year history.
Because what would there be to talk about under that model? Right?
Yeah, we're just hoping it all goes well. It's pretty hard to raise funds. That's how they develop these mutual funds. They seed them. And now at the end, out of 10 mutual funds, there's one left. And that one has $100 million under management and a really solid 3-year track record. But they don't talk about like the other 9 in my example that would have closed.
This is kind of like the legal version of the stock newsletter scam, where,
yes.
where someone sends 3 different stock picks to 1,000 people and 3 different stock picks to 1,000 people. And then they do it enough times that one of those groups gets 3 stocks that look amazing. And they divide that into 5 or 6 groups and send them different picks. And eventually 3 in a row is going to happen by some odds. And then the person thinks that their newsletter writer is a genius. And that's when they ask them for a bunch of money.
Exactly. And we watch it when people start getting heads. It's like you even see them take pride in it, even though they know it's a random event.
Magic wrist, or they say they've got some technique or.
Mm-hmm. Yep. And what it shows is how random it is. Our record, I think, Cory, was 16 heads in a row.
That's what I was going to say, yeah.
That one 60-some-year-old woman. Mm-hmm. And she just kept flipping heads. And we let her keep going, even after everybody else had to sit down. She ended up at 16.
She said something about wisdom is what gave her the ability. That's
Yes. And to which I said, not to embarrass you, but this is how you get a legendary fund like the Fidelity Magellan Fund. Because somebody out of all those mutual funds that have been created and killed, you're going to have a certain amount of people that look like they're extraordinary just due to the massive numbers. So, Cory, do you want to tell our audience why it is they see past performance is no guarantee of future results?
Because it's true.
That's exactly right. That's why that disclosure, past performance is no guarantee of future results, is on every statement. It's everything. Because they know stone solid that asset manager, it doesn't matter if it's Ray Dalio or it's somebody at American Funds, there is no academic proof that these people can consistently or predictably buy stocks that will outperform the market and A little bit of bad news. Neither can you.
Neither can I.
No. Yeah. And not you, Cory, you, all of us. Like we can't do it. And what we think, and this is, you've heard me talk about this before, we think that the E-Trades and the Scott Trades of the world are on the other side of the equation from the Fisher Investments, Morgan Stanley. And they both act like they're on opposite sides arguing with each other, but they're both in the same game, is that somebody can outtime the market. Morgan Stanley just thinks that their great big asset managers and big box financial retail can do it. And Scott Trade says you can do it. You just need a little bit of reading and you'll be able. No, nobody can do it. No one can do it. At least no one we've found who's willing to share what they're doing can do it. If they can, as we've talked about on the show before, they're on a private island by themselves, not talking to you or anybody else. And you know how you know that? It's because if you could do it, you wouldn't tell anybody either. Yeah. All right, let's get into market timing. Market timing is our third illusion. Market timing is any attempt to alter or change the mix of assets based upon a prediction or forecast for the future. The illusion is that money managers are able to utilize market timing to effectively predict up and down markets. Now, there's two different forms this take. One is the one all of you are familiar with, and that's just the idea of moving money from cash, say, to the stock market.
Should I get in? Should I get out? When should I get in? When should I get out? Yeah.
But then the craftier version of this is sometimes referred to as tactical asset allocation.
Or I want some of that. That sounds wow.
How about we do tactical strategic, Cory, asset allocation with perhaps some sort of reverse nuclear split dollar, like whatever. Like it just sounds really cool, but really all it is, instead of trying to guess on a binary, cash versus stocks, what you're doing is you're introducing like 8 or 9 variables and trying to get it right, or 14 variables if you're in a widely diversified portfolio in every asset class. Now you're guessing 14 variables. The truth of the matter is very few can do it, and it speaks to it right in the research. You see, Dalbar is a company that studies investor and investment behavior. And this is a consistent study that they release. Standard & Poor's 500 at the end of 2017, starting in 1985, did 11.35%. 11.35. The average equity investor, 4.28%. I'm going to say that again. 11.35 was the market, the S&P 500. The average individual investor over the same period of time got 4.28% after tax, barely ahead of inflation over the same period, which is 2.62.
So here's another question for you. How could the average investor in the market do a third of the overall index of the market that they're investing in?
Yeah, and it's a blend of two things. One is we're relying on stock selection from those asset managers, which we know is not an effective strategy. And second, because I think inherently people know that somebody else can't predict them or get good returns, et cetera. So what happens when the market has volatility and turmoil? I want to get out. Because all I'm doing is trusting that this competent person at the top of a very tall ivory tower somewhere is managing my money. And suddenly you realize you know very little about their investment strategy. You know little to nothing about the way that they think. You have no idea how many stock positions you have. And you freak the heck out and you liquidate your portfolio. And then when do you get back in? Not while there's blood in the streets. Not in that model. You wait until things calm down. And just like we saw from the recent COVID downturn, and thus far correction, we just produced most of the rates of return for the entire year over the last 2 weeks after, or starting right before to after the presidential election. When there's volatility, that's where returns are, and people break under that. Cory, I think this is one of your favorite charts.
This is there's a couple of my favorites. This is another one of my favorites because it just blows my mind every time. So January 1, 1998, you put $10,000 into the market, a little bit of everything out there, essentially, just a very even index. And then, is it the S&P 500 in this one?
Yep.
Yeah, sorry, S&P 500. And you just put 10,000 in and forget that you have a portfolio. And you find a statement, like you move to a new house, you don't change your address. December 31st, 2017, they finally catch up with you and you get a statement in the mail. You wake up and you would have had $40,000. Now, if you had tried to time the market and gotten in and out during that time, and as part of that movement, guessed wrong just 10 times and missed just the 10 out of 5,040.
That's it.
10 days.
10 days out of 5,040 days. And what, you end up at like 20,000, Cory?
Yeah, half. Your rate of return is in half from 10 days.
Now, my favorite is actually the last bar on the chart, which is if you miss the top 30 days. And if this doesn't blow your mind, I don't know what will. You miss the top 30 days out of 5,040 trading days, and you lost money. You have a negative rate of return for this entire 20-year period. 20?
1 month.
1 month of days that just happen to be the best days of the market, and your return is far lower. And so
you miss 1 month of a 20-year mortgage, they don't even take your house away from you. But
that's a great point, Cory. But you can lose all your investment returns by just missing the top 30 days. And what I loved was this quote from Charlie Ellis, respected academic and leader in the investment management world, and somebody that really speaks to why individual investors need to know this information. In his book in 1993, and the evidence hasn't gotten any better, the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. Or as I like to say, investment managers' expertise looks a lot like my golf game. It is impressive and overwhelmingly negative. Now, okay, so we know that they're not producing performance in a consistent and predictable way. We know that market timing doesn't work, but certainly, Paul, at least mutual funds are inexpensive. See, the cost of investing are the fees incurred by an investor to buy and sell stocks in mutual funds in one of those assets that we own. The illusion is what you don't see can't hurt you. And I would just point all of you, go to Google this term, real cost of mutual funds. Now, we just kind of copy and pasted the first article that shows up, but I want you to notice something when you Google this. You will find very, very, very little from what I might refer to as the financial media, the financial entertainers, in this case, Forbes, that they will write an article like this. And why? Flip through their pages, go to their website, look at the banner ads, and what you will see over and over again is mutual fund company, mutual fund company, mutual fund company, almost all of which are offering actively managed mutual fund solutions. So you're not going to find things like this on the real cost of owning mutual funds. Now, where we kind of condense this, here's the big point. When you put money in a mutual fund, your expense ratio is not your only cost. Your asset management fee is not your only cost. What you also pick up are things like cash drag. The fact that mutual fund managers have to keep a certain amount of money in cash because they have to deal with redemptions from the undisciplined investors that you don't realize you're locked arms with. They've got you in there with a bunch of other people they've just sold the performance of this fund to, and those are the same people that are going to crumble when markets are volatile. As a result, you suffer because they have to keep more money in cash.
So even if you are disciplined and not market timing, other people market timing the same fund you're in hurts you.
Yes.
This is also one of my favorites that just blew my mind the first time that I heard that.
Well, and then think about that. You've got this asset manager. He's got to outperform his index. There's a ton of pressure for him to keep his job. So he's trading, and that trading creates transaction costs that are often not disclosed. Now, again, you guys can go through and get these deeper in episodes 163 to 167 if you'd like, but also check out Dr. Sharkansky on our podcast. He talked about his website, personalfund.com, that gives people insight to the actual transaction costs and some of these other costs they're paying in their fund that are not readily disclosed by the advisors. So the bottom line is the cost of investing can cost you, and it's going to have as a part of it something called the bid-ask spread. Bid-ask spread. Because when we understand what it really costs us in those transaction costs, because there's a market maker that's handling the trades, that's not coming out of our expense ratio. That's coming out of the gains of whatever particular stock transaction that they're doing. And it doesn't report as a cost to us as the individual investor. And you need a tool like personalfund.com to see through that and understand what the internal transaction costs are. And let's hear from Charlie Ellis again when he talks about even something like a no-load mutual fund you would think would avoid this. But the key question under the new rules of the game is this: how much better must an active manager be to at least recover the cost of active management? The answer is daunting. And I would just draw this parallel for you. If you've ever seen a football player, gymnast, somebody's trying to increase speed and strengthen their legs, will sometimes run with like this type of parachute that goes around their waist. Yeah. And the more you run, you've trained like this, Cory, what happens to the resistance?
Harder it pulls.
Harder it pulls. And the same thing is happening with these asset managers trying to trade. It's like running, trying to pull a parachute. The more they do it, the more drag they create against their very objective. The only problem is, in this case, them not moving well with that parachute is your money at stake, not their physical fitness. Okay, Cory, last illusion. We're coming in on the home stretch here.
It.
This is the illusion of letting them handle it. Now, I'm going to stereotype here a little bit. Cory gets nervous whenever I create a disclosure like that. If you guys can't hear the tension in the air.
I think where I know where you're going, it's one that has been predominant for, say, baby boomers.
Mm-hmm.
So
many times we will find it's not always the husband that says, oh, I handle the decisions. Sometimes it's the wife, but it's very easy for couples to say, you just handle that. Or the entire couple, or one of them who handles it, actually delegates it to somebody else and lets them handle it. So one way people do it, either hand it to their spouse or hand it to their advisor. And we just had another conversation with someone who didn't know the difference between a bond and a mutual fund, who now is in charge of their entire household's finances, net worth of about $2.5 million, but had no idea how much money was there and is looking for statements to be able to give us enough information to be able to help them. It's a real issue. Mm-hmm. So if you just have anybody do something for you that you delegate that you're not managing, there's only two potential outcomes. One, they did what they were quote unquote supposed to do, and you look at them and you go, what do you want, a cookie? You were supposed to get us retired. Or they didn't. And I want this to get a little heavy for a second. If you and your spouse don't have your money handled by the time you're in your old age, and what you want is a picture that looks like this, just happy, coasting off into the sunset, no problems, plenty to pay our bills, we don't have to move in with our kids, etc. But that is too often not how it goes. People instead end up in their old age, in retirement, in a mindset, in a condition that they're blaming their spouse. You know, the one spouse says, well, I tried to get us retired and save more money, but you kept wanting a new car. Well, you should have told me we'd be broke in our old age and then I wouldn't need a new car. How long can that go on before you have couples over the age of 60 getting divorced, which happens more often than you think? Mm-hmm. How do you live the rest of your life when you had the expectation your spouse was handling the money and you guys were going to be able to retire, and then do it a bad investment or something else, letting them handle it? It didn't turn out. And it's not just with your spouse, y'all. It's with the CPA. It's with the financial advisor. It's with any of those people that you would say to them, don't worry about it. I trust you. We'll do what you say. Should never come out of your mouth about money. We tell clients that that's a good reason for us to wrap the relationship with them, because it's not our job to, we will be trustworthy, but you are the best person to decide what's going to work best for you and your family for the long run, so that you and your spouse can be this picture, not the picture taken shortly thereafter where she chokes him out and throws him in the water because his term insurance only has 2 more weeks left on it, and otherwise they're not going to be able to retire. She's really doing it for the good of the family.
But even if picture it goes in the best case scenario, where she says to him, you handle it. He says to his advisor, you handle it. The advisor handles it. Husband dies, and then she's never gotten the time of the day from that advisor, doesn't have a relationship or trust him, and has to figure out how to run a financial ship for the first time because she's going to fall in the water if she doesn't.
Yeah,
that's the
in
other
her
reason.
70s.
In her 70s or 80s, yeah.
Indeed. Well, with that, guys, we hope that you've enjoyed this condensed version of the Illusions of Investing. Next week, Cory and I are going to be live 7 a.m. Pacific, and we'll be on YouTube and Facebook. And what we're going to go through is we've just rolled out all these illusions, created all these problems. Well, what is it you can do about it? And we're going to show you guys a mock portfolio, revisit parts of this content, and just have a conversation about the kinds of challenges we see people run into in simply trying to solve for these illusions. Cory, anything else you want to send our audience off with today?
No, we've given more than enough for now. We want to keep it tight and condensed, but tune in live or go find the link to the live show if you're listening to this later for the next part of the conversation.
Now, here is what I want to leave you guys off with. We at Sound Financial Group are committed deeply. This is why we do the podcast. We want people to get exposed to this information. We do not want big box financial retail continuing to harvest the surplus of our clients. We don't want you as a listener to be in a position that you're not being told about these things that go on behind the scenes. You're not being told about what it can cost you to simply buy the products that every magazine has ever told you are a good idea. We want you to be in the position to understand each of your decisions and make better ones for you and your family in the future to help you design, because the design comes first, and then build a good life. It's your good life. It's not theirs. Take control back from big box financial retail. We can all do this and make it through it together, but it requires we have an eye on the future, we have an eye on our financial aims, and that we really take seriously being able to design and build a good life. Hey guys, so glad you could tune in and watch that video. I want to remind you to subscribe, be sure to hit the notification bell so you can get the latest piece of financial knowledge that we release. And don't forget, go to Amazon, get a copy of Sound Financial Advice. Why? Because it'll make you better looking and smarter.